So what is trading? Chances are you trade already and you don't know it. How can that be? I'll explain it right now. Trading is buying and selling things. Trading is making decisions that involve risk and reward. Let's talk about financial trading. We buy and sell items. We even trade items for other items, like baseball cards. Most of us have bought and sold a car. Usually we sell the car for less than we bought it because the car is now used and not as valuable as it was when we first bought it. This usually happens as a trade-in at your local car dealer. Notice the term trade? Every transaction is technically a trade, as you're either trading goods and services for other goods and services, or you are trading money for goods and services. So you're already a trader. Alright, my job's done. The video's over. Hope you like the content. Just kidding. Any transaction requires a buyer and a seller. For that transaction, or trade, to happen, both parties must believe that they're getting a good deal. The same rule also exists in financial trading. Buyers and sellers must agree to a price for the trade to happen. The first new term that we will learn in this lesson is counterparty. The seller is the counterparty to the buyer and vice versa. This is done through a mechanism called markets. These are a computerized version of the same kind of markets you visit every week to buy your groceries. So you know markets already. Video's over. Just kidding. We will dissect financial markets in another video. However, let's talk about a trade. Here's an example. You buy a baseball card at $100, thinking that the value or price of the baseball card will rise to $110 in the future. Later, you will sell your baseball card. You and the buyer agree to a price of $110. So you take the now current price of $110, subtract the past price of $100, and you profit by $10. Let's say that you had to sell your baseball card to pay bills or to invest in something else. It may be that the best price you can get is $90, but you need to sell it even though you will lose money. In this case, the price fell by 10% and you lose $10. The same calculations hold true for anything you trade, whether it be baseball cards, bicycle, houses, stocks, precious metals, cryptocurrency, or any financial asset or product. Let's talk about different kinds of traders and learn some new terminology. There are mainly two kinds of traders, retail traders and institutional traders. Retail traders trade on their own personal accounts, while institutional traders trade for a group or institution. Beginner traders are almost always retail traders. Retail traders now have access to many of the trading instruments and tools that institutional traders do, such as stocks, commodities, crypto, forex, futures, indices, ETFs, and more. This list of items to trade can be called assets or instruments, depending on which one it is. There are also more complex instruments called derivatives, which we will briefly discuss a bit later. Most retail traders buy stocks and hold them longer term as an investment. Perhaps they do so through a retirement plan, such as a 401k, which is managed by institutional investors. Otherwise, they likely buy individual stocks through a brokerage account. Buying individual stocks usually means that the retail trader only profits if the value of their stock goes up. Retail traders do have the ability to go short on stocks and many other instruments. This is a way to profit if the value of the stock decreases, but it is less common for the average retail trader, and there can sometimes be challenges finding a counterparty in the stock market. Take the other side of that trade. Let's talk a little bit about going short. What I'm about to explain may not seem possible for traditional investors, but let's just focus on the numbers rather than how it's accomplished. Let's pretend that there's a magic time machine that allows people to sell and buy things in the future. Because there is. It's called the market. The next trade will involve two participants, Alice and Bob. Going short means that Alice enters into an agreement with Bob. They agree that Alice will sell something to Bob at the current price, but in the future. Let's repeat that. They agree that Alice will sell something to Bob at the current price, but in the future, right? Think about this. Prices change. Things go up. Things go down. But if you have something you want to sell somebody, say, hey, I'll sell it to you in 2 weeks, but I'm going to sell it to you at the current price. Well, what happens if the price goes up? Well, you actually could have made money if you waited 2 weeks to sell it. But what happens if the price goes down? Well, it's better that you sold it now, or at least that you locked in the price that it is right now, because it's going to go on sale later. You get a better deal that way. That's how this works. Bob agrees in this case because he thinks that the value of an asset or instrument will rise, and he will want to be able to buy in the future at the current lower price. Okay, so Alice believes that the value of the asset or instrument will fall, so she gets to be able to sell in the future at the current higher price. For example, Alice thinks that the price of a $10,000 watch will go down to $8,000 in the future. Bob thinks that the $10,000 watch will go up to $12,000 in the future. Alice agrees with Bob that she will be able to sell the watch to Bob in the future at the current $10,000 price. In this case, Alice was right and the value of the watch dropped to $8,000, but she was able to sell the watch to Bob at $10,000. Bob lost $2,000 because he has to pay $10,000 for a now $8,000 watch. Alice gains $2,000 because she can sell Bob an $8,000 watch for $10,000. Bob is stuck with an $8,000 watch for which he had to pay $10,000. That's a $2,000 loss for him. Another perhaps more relevant example would be Alice is interested in shorting Bitcoin. She wants to go short on Bitcoin. The value of Bitcoin is $30,000 at this time for this example. She thinks it will fall to $25,000 in the future. Bob thinks that Bitcoin's price will go up to $32,000, so he agrees to buy Bitcoin from Alice in the future at the current price of $30,000. So Bitcoin falls to $28,000 and Alice gets to sell Bob a $28,000 Bitcoin for $30,000. She makes $2,000. Bob, on the other hand, has to buy a $28,000 Bitcoin for $30,000 and he loses $2,000. The next part of this video may be where some people start to get a little confused, but rest assured the cowboy will explain it in a way that you can understand. Okay? Let's learn a couple more terms that you might hear when learning about going short. Advanced traders may prefer to go short in what is called the derivatives market, where it is easier to find eligible counterparties. This is not always possible in the stock market, although these days it's pretty easy. While we won't discuss much about the derivatives market, we will at least define the term because it is an often used term in trading. A derivative is a contract between two parties and its value or price is derived from an underlying asset. In essence, it's an agreement between two people not to buy or sell the actual asset, but to financially compensate each other as if they did. Why would someone trade this way? Well, there are many reasons, but here is one. When a trader trades oil, they don't have barrels of oil delivered to their house by the counterparty. They settle in cash. Derivatives have allowed people to speculate on assets for centuries. It's said that the derivatives market started with rice futures in feudal Japan. In fact, the candlesticks we use on our trading chart are called Japanese candlesticks. Perhaps we'll talk more about derivatives in another class, but for now let's introduce a new term, leverage. Derivative trades can be very risky because traders generally use what's called leverage. While this may sound complex, this is yet another market tool that you or someone close to you very likely uses already. A mortgage is a form of leverage where homeowners borrow maybe 80% of the money needed to buy a house. If a $1 million home increases by 50%, then the home is now worth $1.5 million, and the homeowner can sell the home and experience that $500,000 gain. If the home loses value, then the homeowner still owes the money he or she borrowed despite the home value going down. Traders use leverage to borrow money extremely short term and allow them to enter into a much larger size position. Just like paying 20% down payment on a house, the trader puts a percentage of their money in and borrows the rest. This makes their money grow faster if they win and shrink faster if they lose. We won't go further into explaining leverage today, but leverage is what can make it easier to find counterparties in the derivatives market. It can also make it easier for a trader to lose all of their money. When a trader owns a stock, the stock is probably going to continue to be worth something if the company doesn't fold, right? The price of the stock might go down, but the company's still there. You still have something to sell in the end, usually. A derivative can simply liquidate. And not only can your money disappear, but you can actually owe money to the exchange if a liquidation happens. We're not going to really explain that right now, but just understand that trading is always inherently risky and derivatives involve even greater risk. The modern world of trading does require a cursory understanding of leverage. My favorite market to trade right now is forex, in which leverage comes standard. This basic understanding of leverage is all one needs to really know in order to begin their education in trading. Trading is not something that somebody learns overnight. Like anything worthwhile, it takes dedication, study, discipline, and practice. Come visit us over at algofactory.tech, and we can show you how we learn about markets. We will help you build your own proprietary trading method, which brings us to our last term, algorithm. I created an entire video on this, for which I have put a link in the corner of this screen. An algorithm is nothing more than a process by which we make decisions based on conditions. Driving to the store, tying your shoes is an algorithm. Anyone who trades successfully is trading based on an algorithm. And as I just pretty much described, you already use algorithms on a daily basis. You just didn't know it. Algo Factory will help you build your own proprietary trading algorithm, which can allow you to possibly become financially independent, or at least less financially dependent on your job or other income sources. In the meantime, remember you're already a trader. You always have been. Life is really one big series of trades because the choices we make have risk and reward. As financial traders, we use tools to quantify the risk and reward so that we can make our choices wisely and, if successful, financially benefit. Come over and join us at www.algofactor.tech and let us show you more about how we gain financial independence. Who knows, maybe one day you can fire your boss and work from home, or perhaps work from a cafe in Europe or a beach in Thailand. You never know. Thanks for watching.